Welcome to the Daily Briefing from interest.co.nz. I'm Bernard Hickey, filling in for David Chaston. Today we'll look at which banks can soon use the new Basel II rules and what that might mean for the housing market. We'll look too at the latest on Vestar's offer to pay out investors who lost money in Bridgecorp and Capital Merchant. And we'll wrap up the latest news from around the world of interest to investors. Here's a story you won't hear much about in the mainstream media. Basel II is a new set of rules about the amount of capital banks have to put aside every time they write a loan. The current Basel I rules were written in 1988 by a bunch of central bankers from the world's biggest economies, and they've been adopted internationally. But current rules have a rather blunt instrument, which specifies a bank must keep at least 4% of its assets in the safest type of securities, such as cash or treasury bonds. This is known as Tier 1 capital. Under Basel I, the bank must also hold a further 4% in so-called Tier 2 capital. Now, under Basel II, the rules change and banks will have to measure the amount of capital they need to put aside depending on the risk of the various loans they make. So it means they'll have to put more capital aside for risky loans and less for not so risky loans. This is important because banks and their shareholders don't like to have a lot of spare capital lying around and would prefer to hand it back to shareholders. It means, therefore, that they prefer less risky loans. But the key change under Basel II is that residential mortgages in New Zealand will have a risk rate weighting that ranges from 35% to 100%. That compares with a blunt 50% under Basel I. Now, residential mortgages in New Zealand are relatively low risk in that we have a history of not defaulting on them. So most people think the risk weighting under the new rules will be well under the current 50% for most mortgages. The end result will be that banks will be much keener to lend on residential property and perhaps less keen on some higher risk business and personal loans. Some believe this has been one of the reasons behind the 15% plus growth in home mortgage lending in the last couple of years as the banks prepared for Basel II. It may also mean some shareholders could look to pull some capital out of their banks, now the central banks, so they don't need to keep so much aside. This week, the Reserve Bank confirmed it will start operating under Basel II from the beginning of January for ANZ National, ASB Bank, Westpac and partially for the Bank of New Zealand. The flip side, though, of this new approach is that when default rates do start to rise, then banks will become risk averse because they'll have to put more capital aside. There's unlikely to be an immediate surge or drop in lending from January 1, but it's worth knowing when you're negotiating a mortgage. A safe mortgage is a great deal for a bank under the new rules. Another tool in your negotiating armoury. Now, it's worth now having a look at the finance company sector in New Zealand, where there's more news out today about the financial advisor network now known as Vestar. A few weeks ago, Vestar promised to make payments in some form to the clients it had recommended should invest in the now collapsed Bridgecorp and Capital Merchant. The background here is that Vestar is owned by the Australian-based MFS and was until recently known as Northplan. It is thought a good chunk of the $1 billion invested by Northplan clients was directed into Bridgecorp and Capital Merchant. In today's press newspaper, MFS New Zealand CEO Jason Maywald has denied suggestions that the offer of a payout is an attempt to avoid litigation by grumpy investors with the former Northplan network. Maywald has not disclosed what sort of payments would be made or when, except to say that investors would find out more early next year. He denied that Vestar or its advisors had acted improperly at any time. He said since MFS has taken over, Vestar has not made investment decisions based on brokerage or commission. Some investors have complained that financial advisors generally have recommended certain finance companies because of the big commissions, not necessarily because it was good for a client. Meanwhile, Kapiti Coast financial advisor Chris Lee has said he would underwrite his clients who had invested in Provincial Finance, which was one of the first to collapse last year. He thinks investors will get back 90 to 95 cents in every dollar when Provincial's wound up, but that he would top that up to reach 100% they had in the finance company. He thinks it'll cost him around the thick end of $1 million, but, he says, it's worth it because it was the honourable thing to do and he's in the business for the long haul. It's worth many investors now asking if their financial advisors will compensate them for recommending investing in the 13 finance companies that have failed in the last 18 months. Meanwhile, around the world we saw another massive write-down of subprime mortgage losses overnight. The Swiss bank UBS has disclosed it lost $10 billion on subprime mortgages. It also announced that the government of Singapore would buy a 9% stake in Europe's fourth largest bank to bolster its capital reserves. This follows a similar such deal a couple of weeks ago involving Citigroup receiving a cash injection from the Abu Dhabi Investment Authority after it also announced big subprime mortgage write-downs. It's clear the credit crunch is continuing to roil global markets, and this will no doubt strengthen the Federal Reserve's hand later tonight when it's widely expected to cut the federal funds rate to try and calm the market. Expectations of lower interest rates in the Northern Hemisphere and a flight to quality seem to be helping the New Zealand dollar and keeping wholesale interest rates here down, as foreign investors look for safe assets. New Zealand has a relatively strong credit rating, and its banks are seen as much less exposed to the credit crunch than the Northern Hemisphere's banks, so for now we're seen as a bit of a safe haven. That's not good news though from exporters who saw the New Zealand dollar surge above 78 cents this morning, close to a 5-month high. However, New Zealand's exporters and importers did get some good news today in better terms of trade figures, showing export prices were down slightly, but import prices were down even more, no doubt in part because of the stronger dollar. I'm Bernard Hickey standing in for David Chaston. Check in tomorrow for the freshest finance news on the web. Back again with David Chaston.